Introducing Themes ETFs. Our ETFs seek to provide a way to own the opportunities that are shaping the future and moving markets, with expense ratios 40% cheaper than the average charged by our competitors.
Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor for ETF.com.
This week, we're talking with Tony Kelly, co-founder of BondBloxx. Tony, thanks for joining us.
Hey, Tony, how you doing? I want to start off with a question about BondBloxx. I mean, obviously it's a really cool name for an ETF issuer, but what exactly, give us a little bit of the backstory, if you would.
Sure. Yeah. I mean, look, name matters, right? And as the name implies, we are in fixed income focused ETF issuer. We started back in 2022 with a suite of fixed income products. We've built out a suite of high yield products, and we've added emerging markets, we've added treasuries, and today we listed our first investment grade products. So we've got 23 products in the marketplace, and we're fast approaching $3 billion in assets in just under 2 years since our initial launch.
That's great. And I want to ask you more about specific products later, Tony. But before we get into that, I was looking through the materials on your website, and I noticed that you say that you expect that fixed income is going to eventually represent 40% of the ETF market, up from 20% today. Why do you think that is?
Sure. You know, we spent a lot of time looking at this, and we spent a lot of time thinking about this even before we launched the business. And a couple of factors. One is we've noticed the client adoption over the last half a dozen years has really picked up and really increased since the initial ETFs were launched in 2002. There's also been significant changes in the underlying market. Fixed income market has become much more prone to electronic trading, basket trading. So that drives a lot of institutions to sort of think differently about how they trade fixed income markets. They think in terms of baskets, which is analogous to ETFs, and we think institutions will continue to use ETFs in an increasing way. The other reason that we think that the fixed income ETF market is prone for growth is that when we compare it to the growth of the equity market, you have to remember the equity ETFs were launched about 10 years before the fixed income market, and it really is tracking kind of the same growth trajectory and sort of growing at even a faster CAGR than the equity market is right now, kind of similar to where the equity ETFs were maybe about 10 years ago. So we think all of those basically point to increased usage, increased assets, and there's a gap in the market. There's a gap in terms of the number of fixed income products available for clients. When you look at the ratio of products relative to the sort of proliferation of products on the equity side, it's much less developed. So we think there's a lot of opportunity there to build out more and more products for clients.
Gotcha. This certainly does seem like a long-term secular trend, but it also seems like there's been an intense wave of interest starting, in 2022, 2023, because interest rates have just been going through the roof until recently. We, of course, saw that big whoosh up to 5% in October of last year, and then it dropped pretty quickly down to 4% on the 10-year Treasury yield. What's your expectations for interest rates? Do you think that, we've peaked finally and we're going to be choppy from here, or do you expect rates to eventually head back down to where they were in 2020, 2021, around 2 or 3%?
Yeah, it's an interesting question because that was one of the things we were discussing before we had launched BondBloxx, right? That we had been in this very long-term decline of interest rates, and there was also a pretty long-term period of just lower market volatility, and we kind of felt like those two things were bound to change. And this was probably 2021 when we were kind of thinking about starting this business. Timing's everything, right? So we certainly were right, I guess, on the forecast, but couldn't have imagined how quickly interest rates were going to come up, and um, how much the world was going to change in the next 12, 18 months. I think we're closer to sort of peak rates than not, but our forecast is definitely rate cuts from here, like we would imagine that'll start here in 2024, but not expecting rates to get down to where it was in 2021. That will probably be kind of in a more normal interest rate environment where there's coupons to be earned from a fixed income investments.
Let's going back to kind of your brand a little bit. Your value proposition is that you provide precision tools for fixed income. What specifically do you mean by precision tools, and how do you see those tools being used by investors and financial advisors?
Precision just means just that, right? It's sort of like a more granular view, and maybe I can pick our high yield ratings funds, for example.
Mm-hmm.
You look at, high yield, and there have certainly been good products in the marketplace for a long time. But when you think about it from a ratings perspective, there really is sort of a market within each one of these markets, right? The sort of double Bs are a very different, almost asset class than triple Cs, which are the higher yielding portion of high yield. And from an investment perspective, we felt, the same way advisors think about building out their equity asset allocation in much more granular fashion than just, broad bucket equities, right? The advisors allocate to large cap, mid cap, small cap, maybe even by sector. And the same dynamics, kind of the same drivers exist in the fixed income market, right? So, on getting back to kind of high yield, if you've got a negative outlook on the market, and you still want to be in high yield, maybe you don't want to be in triple Cs. So with a more precise exposures, more precision in the products that you're using, you can build a portfolio that only gives exposures to double Bs or single Bs, or the reverse, that you think that the outlook is good and you want a more of a risk on kind of tilt, then maybe you'd want to overweight triple Cs and own more triple Cs than you get in the broad products, which right now is about 10 or 12%. Maybe you want to double that allocation to 20% and have a more risk on profile.
Tony, another category of ETF you have is your target maturity, your target duration ETFs, which is obviously different than a lot of other bond ETFs that are out there that target maturities. Can you talk about, how the target duration ETFs are different than target maturity ETFs and why they might be better for investors?
Sure. Yeah. One of the things that we've heard from advisors through the years is one of the reasons that they use and allocate to fixed income or treasury ETFs is to manage duration in their client's portfolio. And a pretty typical story that we hear from advisors is they've got a benchmark, maybe it's the ag, they build out the credit portion, maybe they select different investment grade ETFs to sort of get in those exposures. Then they've got the mortgage component, so they build that out some way, whether it's with mutual funds or whether it's directly buying the mortgage pools or one of the ETFs. And then the final step in the portfolio management process is to make a decision relative to their benchmark on duration. And do they want to match the duration to the ag? Do they want to extend duration? Do they want to shorten duration? And then they look to fixed income ETFs to help them do that. And until we launched the duration focused products, it was kind of a two-step, somewhat indirect process where they were buying ETFs that were focused on maturities that could have durations that drifted from 7 to 10 years, let's say, in the 7 to 10 year product. So if what they want is a precise exposure at the 10-year duration point, now they can get that through these products.
And another group of ETFs that you have that I find interesting are the corporate bond ETFs tied to different sectors. You have one, for instance, for healthcare, technology. How are investors using these? Are you seeing demand for these products?
Yeah, we're definitely seeing demand, and there's a lot of interest. I mean, admittedly, the growth has been a bit slower than we would like, but some of that is, it's a function of these tools have never existed before, and advisors haven't been able to, and institutions haven't been able to basically invest this way in the past. So it definitely is a bit of a learning curve, but there are some institutions that are already investing in them. And it makes sense, right? Like when you sort of think about, the sort of different sectors within high yield, right? Energy is a very different sector with a very different set of risk profiles than healthcare. And maybe you wouldn't necessarily want one or the other, or sort of feel differently about a particular sector. Again, bringing it back to kind of the equity market. The equity markets have been doing this for years and years, right? Sort of allocating maybe not towards just the S&P 500, but maybe half of the sectors are overweighting some of the favorite sectors. High yield sectors have the same and a very interesting dispersion profile that the sectors are not as correlated as you might think, that there really is a performance difference in the highest performing sector and the lowest performing sector in any given year.
I want to ask you about a specific fund, the BondBloxx USD High Yield Bond Sector Rotation ETF, ticker HYSA, launched in September, has a little over 31 million, expense ratio of 55 basis points. How exactly does this strategy work, Tony?
It's a great question. So that was, again, very much influenced by feedback that we received after launching the initial high yield sectors, that advisors were interested in them and they liked the idea and they understood the research that there's a dispersion in returns, but they just didn't have the capabilities of making that selection on their own. And we got the feedback that, this is great, but is there any way that you guys can do this for us? So, we basically sort of took it back to the lab, if you will, and sort of thought about it and said, yeah, we could definitely do this. And we do it in a couple of different ways. We've worked with some model providers like Dorsey Wright that has a model that sort of offers these sectors in a rotating fashion. But we thought we could do one better for some of those clients that wanted just the single ticker solution. We partnered with Macquarie Asset Management to develop the strategy, and the fund holds the different sectors in the appropriate weights and looks to outperform the broader benchmark. So it's an active fund using these passive tools, which is pretty common in the industry.
Yeah, it's a really interesting fund, Tony. It's going to be exciting to see the performance on that as we move through time. But if I'm not mistaken, we're recording this right now on January 25th, and you launched 3 new ETFs today. Can you tell us about those?
Sure. Yeah, really excited about these products. This is, I like to call it, look, it's the best part of the investment grade market, right? The triple B, I think, have long been understood by professional investors as the part of, or as part of the strategy to sort of beat their benchmark. Sort of overweighting triple Bs has been part of those strategies. So what we have is maturity focused investment grade, but 1 to 5, 5 to 10, and 10 plus. But instead of the full broad range of investment grade corporate bonds, it's just the best part. It's the triple B part that over the last 20 years has outperformed the broad IG market by 50 basis points without picking up any additional risk in terms of default risk. So it's the same default risk we see in triple Bs as the broad IG, which also over that same time period of 20 years has been about 20 basis points. So really low default risk and sort of an opportunity to outperform the broad market.
Yeah, a lot of good stuff there. A lot of background on what you're doing and the stuff you've got coming out now. But Tony, what can you tell us about what you've got on the drawing board? What's the future look like? And has the name BondBloxx kind of boxed you guys into sticking with fixed income forever?
Yeah, it's a good it's a good question. It might be a little awkward to do thematic equity with a name like BondBloxx, but that was part of the plan, to be honest with you. It was to deliberately and relentlessly be focused on one segment of the market, and focusing on fixed income is not a niche, right? Fixed income is a pretty big market, so we thought it was well worth the effort, and sort of the fixed income market certainly deserve the time and attention. By focus, we don't think about it sort of boxing ourselves in. We kind of think about it as we're experts, right? We're basically carving out, a new way of thinking about this market, a new way to sort of find opportunities for clients. That's kind of the sort of how we viewed it.
Excellent. Well, good stuff. Thanks a lot for being here. Thanks for all the great information.
Yeah, thank you. Thanks for having me.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.
Introducing Themes ETFs. Our ETFs seek to provide a way to own the opportunities that are shaping the future and moving markets, with expense ratios 40% cheaper than the average charged by our competitors.